Did you know that the US federal government is the world's largest debtor? The borrowing is done through a mix of securities and financial markets that have developed additional products around Treasury securities in liquid secondary markets. In this video, you will learn the similarities and differences between Treasury bills, bonds, tips and strips, the reasons why an individual investor might choose each one of them, market trading volumes, the trends in interest rates, and other information that is relevant to this topic. My name is Ana Patino.
My name is Douglas Peralta.
And my name is Dareth Flores, and we will be starting with Treasury bills and bonds. Treasury bills are short term debt obligations backed by the Treasury Department of the U.S. government. The maturity can depend on the Treasury bill. It can be either 1 month, 3 months, or 6 months. The longer the maturity date, the higher the interest rate. U.S. government uses the funds raised from selling Treasury bills to fund various public projects such as construction of schools and highways. And then the purchase process of a Treasury bill depends on whether it's sold at a discount price or a premium price, and they can be purchased by the government or by auctions. On the other hand, bonds are fixed income instrument that represents a loan made by an investor to a borrower. A bond has an end date when the principal of the loan is due to be paid to the bond owner and usually includes the terms for variable or fixed interest payments that will be made by the borrower. Bonds are used by companies, states, governments to finance projects and operations. Now we will discuss similarities between bonds and Treasury bills. They are fixed investments issued by the U.S. Department of the Treasury. They are safe investments, and they are low risk and low interest rates of any fixed income security. The differences of Treasury bills and bonds depends on the bond lengths and how they are held until maturity. The terms for that could be up to 30 years, in contrast to the Treasury bills, which are issued for terms for less than a year. Reasons to choose Treasury bills and bonds depends on which one the person might prefer. For Treasury bills, they are the safest investment. For bonds, they are fixed return on investment and they have a low risk. We will now talk about tips and strips.
TIPS are Treasury inflation protected securities. The principal of a TIPS increases with inflation and decreases with deflation, as measured by the Consumer Price Index. When a TIPS matures, you are paid the adjusted principal or original principal, wherever is greater. TIPS pay interest twice a year at a fixed rate. The rate is applied to the adjusted principal, so like the principal, interest payments rise with inflation and fall with deflation. You can pay TIPS from the Treasury Direct. You can also buy TIPS through a bank or broker. You can hold a TIPS until it matures or set it before it matures. On the other hand, strips are fixed income securities sold at a significant discount to face value and offer no interest. These zero coupon bonds come about when the bond's coupons are separated from the bond or note. An investor return is determined by the difference between the purchase price and the bond's trading value, or face value if held to maturity. Reasons why an individual investor might choose TIPS or strips is that TIPS protect inflation and adjust to inflation, diversify their investment portfolio, and supplement retirement income. Strips cannot be sold directly to investors. Now, to have a better understanding between the 10-year Treasury constant maturity rate and the 10-year Treasury inflation index security with constant maturity, we'll take a look at the data presented by the Federal Reserve Bank of St. Louis. First, we'll look back in history and look at June of 2007, when the 10-year Treasuries rates were normal. In 2007, the 10-year Treasury constant maturity rate was a 5.10, compared to the 10-year Treasury inflation index security at a 2.69. This was somehow normal because macroeconomic environment was not abnormal. However, when we take a look at December of 2008, when we see the biggest difference between both treasuries, we see that the 10-year treasury constant maturity was 2.42 and the 10-year treasury inflation index security was at 2.17. We see a significant decrease in the rate for the treasury that is not adjusted to inflation. Meanwhile, the treasury that is adjusted to inflation presented an increase. And the reason behind it, we see it when we take a look at the values of inflation. Remember when we look at the June 2007 rate? During that time, the inflation rate was somehow normal, was at 2.41. That is usually what the US wants the inflation to be at. However, during December of 2008, we saw an inflation decrease to at 0.25. What this meant is that the treasuries that adjust to inflation would have to decrease the principal in order to adjust to inflation. And what that does to the rate is that it increases the rate. The treasuries that don't adjust to inflation don't do this and are not able to adjust to these changes in inflation. Now, the similarities and differences between tips and strips is that strips are created from tips that do not have a coupon rate and pay a floating interest rate. Tips contain low risk and have shorter long term bonds. Strips have no interest payments. The following graph presents the U.S. Treasury average daily trading volumes for years 2018 and 2019. The data has been retrieved from the U.S. Department of the Treasury. Trading volumes are often viewed to have a relationship for liquidity because high volumes suggest that buyers and sellers are able to regularly meet and transact. In the graph, we can see values ranging from 105.2 billion US dollars in June 2018, that it was the lowest trading volumes, to a highest of 139.9 billion US dollars in January 2019. That is the highest trading volume during this period of time. Volumes are generally higher in liquid markets, but it's also important to highlight that volumes may also be elevated in periods that are increased in volatility where there is lower liquidity. Now we will continue with supporting information.
We're going to be talking about the trends in interest rates. Um, it's composed of the rise in interest rates, where it causes an increase in federal funds, along with borrowing money for them that is more expensive. People will eventually have less expenditures that will limit the amount of money that it is available to spend. On the other hand, it also comes with a decline in interest rates. Lowering the interest makes it more feasible to borrow in the money market with low rates, increases the borrowing amounts, along with creating more debt overall. The length of the time also impacts the rate as well. With the short term interest rate, it can also be known as money market rates. That's composed of average rates as seen as a percentage that usually matures within a year or less. And then there's also the long term interest rates, which is a government bond maturing over a period of 10 years, if not more, that is determined through changes in price over time, also seen as percentage for average usage and higher costs.
Finally, here you will see the references that we have used in order to provide accurate information in this video.